So group audit. Think about the situation where we have companies, where we have parent company, maybe like Cooperative Bank. It actually took over Kingdom Bank. So this one is a subsidiary Kingdom Bank. Now, there are situations where you might find that when one company, which is the group company or the holding company, like now here, Cooperative Bank, took over Kingdom Bank at some point, Kingdom Bank was having its own auditor. They were having their own auditor. And so let's say that the auditor was PKF, but the auditor for for Cooperative Bank was PwC. All right. Now, immediately, this parent company take over this. They have to decide. They have to agree because they have majority shares, or maybe they have control. They have two options now. They might require PwC to audit Kingdom Bank, or they might just accept that Kingdom Bank can be audited with the current auditor, by the current auditor, which is PKF. So PKF can continue auditing this firm, this company, or they can maybe try to agree so that the parent auditor can audit this. So they have two options. Now, in case the company agrees that the current auditor can continue auditing, then this one is a joint audit. It's joint audit because two firms are auditing a group of companies. These are two different firms auditing this. But now, what is very important for you to understand that there is some kind of risk that comes as a result of audit. I'm sure you will not want to sign a report that has been done by somebody. Remember this report, when it is being signed, they are going to sign a group audited account, group audit, which includes the report from the subsidiary company. It will be part of the whole group. As an auditor, you might not be comfortable signing a report that was done by someone else. He has done the job, but you take the risk by signing, confirming that they're okay. So because of that, in exam, they might ask you, what are some of the factors that needs to be considered by a group auditor, which is PwC, before accepting or signing the work of a subsidiary auditor, especially where they were done by different audit firms. The group auditor is different from the subsidiary auditor. At what point or what factors should PwC consider as they accept the work that has been done by the subsidiary auditor? Now, these are the factors. Because of the risk, number one, the parent auditor, which is this one here, parent auditor might want to know what were the audit procedures that were followed by PKF. They are not working with PKF, but they want to decide this, they want to sign that report. Some of the things that you might consider before signing, number one, is to know whether these guys have used the right audit procedures. So number one, you write that factors to be considered by group auditor in order to accept or when accepting the subsidiary auditor's work or signing the subsidiary auditor's work. Number one, they want to know the audit procedures followed when PKF was auditing the subsidiary. That is number one. I hope you are writing the audit procedures that were followed by the subsidiary auditor. Number two, experience of the subsidiary auditor. These guys, do they have enough experience? So they will want to consider that these guys have the right skills. That is number two. Number three, they will want to know the sample criteria or the samples that were used when they were arriving at this point. They want to know the sample. the samples that were used, were they sampling 90%, 100%, or just 10%? Which sampling criteria did they use? Again, they will want to look at the quality of audit evidence that were picked by the subsidiary auditor. We said that there are qualities that you need to consider in audit evidence. Good qualities of audit evidence that we agreed that can also come in exam. We say that a good evidence should have certain qualities. It is an evidence that has been picked by the auditor. It might be evidence, it should be evidence that has been originating from the original document, original documentation, like title deed, the original title deed. It should be maybe evidence that has been observed by the auditor. It is an evidence that is actually derived from the system of the client. The evidence that has been picked directly by the auditor from the system of the client system, especially where internal controls are very strong. So we have looked at those kind of qualities of good evidence. Now, that is the same thing that the group auditor will want to check before accepting the work of PKF. They want to know what is the quality of the evidence that they have. At the same time, they want to look at the sufficiency of those evidence. Are they sufficient enough? It might be quality, but not sufficient. So they need to know the quality and quantity of the audit evidence. Quantity and quality of the audit evidence. So maybe maybe they can also check the risk assessment criteria. How did PKF assess the client risk assessment criteria? How did they assess the risk assessment? They can also check that. So there are quite a number of things that they might consider, right? They might also consider whether PKF used the work of an expert. Did PKF use the work of an expert? If yes, who are the experts? They can also consider that, whether there was any use of the work of expert there and who are the experts. And so we have so many answers that you might think about, but in exam, there is no fixed answer. I normally tell students that anything that you are feeling can be correct. Just write it in your answers, but try to convince the marker that is relevant with the question that has been asked. Kama wewe ungeangalia nini? If you are the auditor, ungeangalia nini? We can even talk about the scope of the audit. Add that one, the scope of the audit work. To what extent were they doing this audit? What was the scope? They might also consider the scope of the audit work. So those are some of the factors that might be considered. Another group, they might ask you, because of such kind of risk that the auditor is exposed to, the group auditor is exposed to some risk. What should the group auditor do? In that particular case, they are basically asking you, what should he do before accepting this kind of work, or when accepting, for him to be comfortable signing the report? What should he do? You can write those factors that I've given you, and then you add something like maybe the group auditor might want to attend some of the meetings. Remember, we have the partner here who is going to sign a report. He has never even met the management here. They have never met, but he's going to sign this report. So for him to be very comfortable, there are things that he can do so that he can sign. I'm not asking you now factors that he should consider before signing, but the activities that he can perform while signing or before signing. There is a slight difference. Some of them are the same factors that should be considered. You can put those ones that I've given you, but then you add a few. Like, for example, he might want the management here, the partner at PwC might want to attend a meeting that is going to be done between PKF and Kingdom Bank. The reason why he wants to send a representative or attend a meeting so that he can get clarification on some issues that he might be having queries on. You know, if you attend a meeting, then things become open. You also have an opportunity to ask questions. So as you sign, at least you are comfortable. Those are not factors to consider. That one is not factors to consider, but that one is just an activity or some of the things that he can do in order to sign when he's comfortable. So in exam, if they ask you, inafaa afanye nini, you at least akisign ako comfortable, then number one, he can send somebody to represent him during the meetings, especially the opening and closing meetings. The opening meeting will help him to understand the scope of work, the nature of risk, and the kind of activities that is being done here. So he can actually evaluate the risk level of the client. And then he can even know the audit procedures that should be followed. So when these guys have done the work, he can know that they were supposed to follow these procedures. End of the audit meeting, which is called closing meeting, he can also attend the closing meeting after the audit. He can represent somebody, he can send somebody to represent him. The reason is so that he can be able to ask some questions, because he can also be having some clarification that he wants to get. So through such meetings, he can get such clarification and he will be comfortable. That is number one. Number two, they can actually send somebody from here, 2 or 3 people from here to join this group. Wanatuma watu wao kutoka huku kama auditors kama watatu hivi ama wawili, wanaambia go and join this group so that you can be our eyes, mkue kama macho yetu pale. So as they do the audit procedures, you can also, you know how we do our things. We kaa hapo, unaangalia vile wanafanya hiyo kazi, msaidiane. They at least tukisign, at least you are there to help us. Remember, these guys are having their own procedures for quality review. And PwC cannot come and control auditors from PKF. But if they send their own guys, 2 people from there or 1 person from here to come and join this team, they can be able to ask them, what did you check? How did you see this? Did you check this? You know, doing that what we call hot review, they can be able to evaluate the risk level in this particular audit process. So they can send somebody from here to be representative. That is another way of reducing audit risk. But then they can also ask you, what are the benefits of joint audit? So we have joint audit where maybe the management agreed that, okay, because PKF has been appointed, we don't want to terminate the contract. We can allow them to continue, but we'll send 2 people from here to come and assist them audit. So we have 2 audit firms auditing a subsidiary firm, subsidiary company. We have 2 people from here and 2 people from PKF auditing this one. That one we call joint audit, not because it is a joint group, not because the parent is one they are going to sign, but it is joint because we have 2 different firms working together at the same time on the same assignment. So it is joint audit. In exam, they might ask you, what are the advantages of joint audit? An audit where PKF staffs have come or perform the work jointly with PwC. What are the advantages? Number one, you can write there, when these guys join this team, we already have an existing firm, that is PKF, and then PwC joins. So it is joint audit where one was existing, another one joined them. Advantages, number one, there will be share of responsibility. So in case of any mess that has gone on, there's something that has gone on that is wrong, there's a mess up, these guys can actually share the risks. So there will be sharing of risk, that is number one. Is joint audit and group audit the same? Joint audit and group audit, in fact, they can actually find themselves together. When you are looking at this and this separately, it is group audit. But it's normally coming together when these guys fear, they have seen the risk. Group audit, this one is a parent, this one is a subsidiary. Now, when we are trying to evaluate the risk that is here, we are looking at the group audit, where we have a group for branch and then the parent. But if they are of different firms, audit firms, then it is joint audit and also group audit. Why? Because we have 2 different firms join together to perform audit for the group. It doesn't matter where they were. But again, we have only group audit, where the parent company has an audit firm which is auditing the whole group. No any other audit firm, not two audit firms. Ni moja tu in audit kila kitu, auditing the group. That is also group audit. And also it has its own challenges. You might be told that you are doing group audit. These companies are actually running in different activities. The parent is doing maybe textile industry. These ones are on financial on different fields. Then now they are asking you, what is the challenge in group audit? That one is purely group audit without joint. There is no another firm who has come in to assist so that the group financial statement has been done by two people. No. One audit firm doing the group audit. The risk there, or some of the challenges here, when it is being done by one person, but we have so many groups, ni kwamba the firm that is auditing the group might not be having the knowledge in every industry. You cannot have knowledge in mining, financial, textile, farming, everything, no. So that is one of the challenges. Number two, maybe the capacity to do the job. They might be in different fields where you have to do complete audit for one, another one, and then now you come and compile. That is also becoming complicated. So complexity of the kind of business that they do also is becoming a challenge. So we have group audit that is conjoined, that brings in the perspective of joint. But then we have pure group without joint audit. So you need to understand which one. Is it group and joint, where two firms are there, or is only group, where one firm is doing the group audit for the whole firm, the whole branches or the whole group or company? Then we have another situation where we have two audit firms, like now this one. One is auditing branch or subsidiary, another one is auditing the parent. Now, that one also you need to know the challenges. But now, the advantages of joint audit, they might ask, especially under intermediate level, they might ask you, what are the benefits when you are doing joint audit? And I've talked about sharing of risk. That is number one. Number two, especially where one company was already existing and the other one joins, they'll be able to exchange. This one has an advantage. The one which joins the other has advantage. Because already PKF has been auditing this company for some time. They understand the risk level and risk profile of this particular firm. So when this one joins, they'll be able to tell them the areas of high risk. Watakuwa wanawaambia, instead of wasting time here, angalia hapa, they have weaknesses in credit policies, they have weaknesses on HR or board, they can be able to point. So that one is also an advantage. You are doing group audit, but the one is already there. He can be able to share with you the information about the risk level, or even some of the risk profiles, the risk profile of the firm or the company that you are auditing. That one will save your time. So it saves time because you can easily understand. It saves time because the firm that is already there shares some of the information that can save their time. Another advantage, it is also saving time because they are a group team. Our wameleta watu wake experience, you also bring in, so you have a bigger team. A bigger team, of course, will be able to cover a large area of scope within a short time. That is also another perspective that you can look at it from. It's also save time in terms of the numbers. But again, other advantages are like they're able to share knowledge. Even if it was a group audit where one was not existing before. Let's say that this company is so big, they have decided that this particular firm, like Coca-Cola, let's now bring 2 audit firms or 3 auditing Coca-Cola at the same time. They'll be able to share knowledge. There's something that PKF does that PwC doesn't know. There's something that PwC does that KPMG doesn't know or they don't do. When you come together, you're bringing people from different backgrounds. They can be able to share knowledge. That at the end of the day, at the end of the assignment, they'll be better off than those who didn't do joint audit. So that is another advantage of joint audit. The firms come up with the different skills, they are able to share, and that one is benefit for each other. So So in exam, if they ask you, you talk about time saving, you talk about, and of course, we can also not forget about efficiency and quality of work. Remember, when you have group audit, PwC, when his team is here, they want to show that they are perfect. PKF also want to show that they are perfect. The audit procedures and the quality review procedures, they want to do it thorough so that they don't be undermined by the co-partner or the other team, the joint partner. They don't want to be the ones who are seen to be doing a less quality job. So because of that, people try to make it or do it to the best. They become efficient. So the quality of work is also better when it is group joint audit, because you don't want to do lazy job. Just imagine hata wewe sahi, kama kuna kazi, maybe you're working somewhere in an audit firm, na kuna joint audit that you're going to do with a different audit firm. I'm sure that you will not be lazy. You want to do it to the best. Ndio hao wengine wasijue ati nyinyi mnakuanga tu hivi, mnafanya kazi mbaya. You don't want to show that. At the end of the day, the client will have benefit because you guys are competing in terms of the neatness and quality of work and even time management. So again, quality of work is improved. So you have 4 points: time saving, quality of work, we have risk sharing, and of course now we have knowledge sharing. So those are advantages of this particular assignment, joint audit. What are the challenges? What are the challenges? In a case you are asked in exam, what are the challenges of having joint audit where two firms are auditing at the same time? The challenges. I think there could be a conflict in terms of procedure. Remember, there's a way we do our things. There's a way you do your things. At the end of the day, we are expected to have one report. So we are telling you that this is the way to go. Well, it is this way. So again, it can bring delays. We have to consult each other. We have to learn fast so that we agree, such kind of things. So those kind of conflict in terms of the way we do our reporting presentation, because we come from different background, is one. It is also true, Sharon, it is also expensive in terms of resources. In fact, other advantage is that it is cheap in terms of resources because the firms were able to share resources. That was another advantage. You can share resources. Now, it is expensive in terms of the company that's being audited. They have to pay 4 people or 3 from here, 3 from here. They're going to pay a lot of money compared to if it was being done by one firm. They will give few staffs, you negotiate with one staff, with one firm. But in this case, you have to pay money that will be divided amongst the 2 or 3 firms. So again, resources, you have to give them system, you have to give them maybe laptops if they want, and some separate machines for use, such kind of internet, then you pay them well, you accommodate them. So on the part of the company that's being audited, it is becoming expensive. But on the part of the audit firms, it is less expensive because they only give the number of staffs that they feel are few, because they know after all how pia watapeana, so watapeleka watu wengi sana. So, and then some of the resources can be shared with the firms if they are working jointly. So unafikiria along that line, you think along that line. Another thing that can be advantage is the culture. Every company has various or different cultures. Now, in a situation where we are working together for only this assignment, hatujaifanya kazi before, the way we do our things are different. Again, cultures differs, and that actually can also impair on the coordination. How we relate can also be affected by the cultures or our values. People have different values in different organizations, even if the procedure is the same, but we cannot work harmony because our values and cultures are different. That is also another thing that can cause trouble during that process. And then there will be excuses again in case of risks or there is some lapse somewhere. People will always excuse each other. Nobody wants to take responsibility. Nasema hii area so and so ndio alikuwa na audit. Nikikuja hii side tena nasema this one so and so ndio alikuwa na audit. So nobody wants to take responsibility. We are saying that, you know, you are the one who was supposed to audit accounts. But I also say that, okay, I was auditing accounts or bank, but you're the one who sends circularizations. You are the one who sends circularizations. So if there is a problem under reconciliation or account audit or bank audit, then again we start blaming each other. So there's a possibility where nobody wants to take responsibility. So, is there any question about group audit? Any past paper question that has been set on the same? Able to angalia? Okay. There was a question under intermediate. That was 2011 question 3. December 2011. The question was asking, explain the term joint audit. That was Roman 1. So you will say joint audit is an audit of a legal entity done by 2 or more audit firms to produce a single audit report. It is an audit of a legal entity done by 2 or more audit firms to produce a single audit report. Joint, wamekuja pamoja. That is not group audit. That is joint audit. So, but joint can be within a group. So you need to know, as long as people are coming together, then it is a joint audit where audit firms are coming together, 2 or more. So I'm repeating, it is an audit of legal entity by 2 or more audit firms to produce a single audit report. Then question 2 was asking, highlight 3 advantages and 3 disadvantages of joint audit. Advantages and disadvantages of joint audit, 3 each. So number 1, you'll pick a point from there. I'll just give you what the answers are, and then you can pick the point in short notes. Number 1, 2 firms can also stand stronger together against aggressive accounting treatment. There is that kind of synergy. How do you call it synergy? When you come together, you become stronger. Against aggressive system. In this way, joint audit effectively becomes a guardian for audit quality. So we are talking about the quality of the audit report here. Quality of the audit report. When you come together, you can do much work and of a better quality. That is summary. You can do more with a good quality. Number 2, audit committees and investors have additional assurance that the audit opinion which they will present is complete. Again, the shareholders will trust you more if you are from different firms. Like now, PwC and KPMG, if they are working together, they are checking each other. We say that, right? You don't want to be lazy. Hautaki kupeana or leave some loopholes. Kila mtu anataka kuwa perfect. So because of that, people knows that you're going to be giving a good quality report. And because of that, the opinion will be giving, the opinion that will be given will actually enhance confidence. Investors and the audit committee will have confidence in the opinion that you're giving, being that the 2 firms were checking on each other. So there will be much confidence in the opinions, which is quite true, Cindy. So the level of confidence will be high because they believe that there's additional assurance. People are checking on each other. The other one, a joint audit allows the rotation of audit firms and retains knowledge and understanding of group operations in a way that minimizes the disruption caused by a single audit firm. In a way that minimizes the disruption cost when a single audit firm is changed. So they are saying if you are doing audit firm where we are doing group audit, this person is giving an example situation where we have a company, like let's say cooperative bank. Initially, it was being audited by, we have 3 years. You know, audit firms should be going around. Audit firms should be going around when you are auditing to avoid familiarity threat. To avoid familiarity threat, you should not stay somewhere forever. So they are saying, let's say that one firm, we have year 1 or 2001, no, 2020, 2021, 2022. Then we have 2019. So PwC might have started auditing this year. When they are coming to 2020, PKF is also here. This one is PwC. Here, PKF has joined them. Here, they are still together, the two firms. But now, because PwC has exhausted its 3 years, PKF will still continue. Because they have only done 2 years, they have done this and this, they can still continue. So they are saying in joint audit, especially where there is a rotation of funds, there will be less disruption, especially where one fund has been left out because of that issue of rotation. Mlikuwa mnafanya watu watatu wawili, lakini moja ametolewa juu term yake imeisha. They have to rotate. We still have another one going on who has done audit before and understands the client very well. So there will not be interruption. They are not going to start afresh. Wanaendelea tu, and then a new audit firm, which is the third one, can join. So at this level, maybe KPMG can now join, KPMG can now join PKF. Because it has to be done by 3 or 2 companies, we maintain group. So it doesn't matter when the other one is coming in. What remains is that at least every given audit must be done by 2 people. So the first one, there were maybe a different firm here, probably this one was KPMG or another audit firm, or even EY. So EY, term yake iliishia hapa. Then here, PwC inaendelea, but now PKF picked. And then they continue the same. On the third year, huyu term yake imeisha hapa, PKF continues, but another firm comes in. So if every year they are doing 2 firms auditing, another one will be retiring as the other one continues with the new one who has come in. There will be seamless takeover. So there will be minimum or minimized disruption because one of the firms who understand the company is still there. So at Kitoka, you don't need to have a meeting again with the firms and start explaining to the new firm that you know this is where you need to audit. These are the areas that we do. You don't even need to introduce yourself again. No. The existing firm will be able to support the new one to be able to catch up very fast, and they can continue the operation because already they understand everything. The internal controls, organograms, the structures of the company, like branches, areas of high risk, everything they understand. Management letter issue for the previous year, they have the copy. They can simply take over and start revising and check if everything has been implemented as was recommended. So those are the things that they are saying. There will be little disruption. The next point, they are saying that rotation of audit firms can mitigate the risk of overfamiliarity. This one again will help. If there are 2 firms that are going around like that, it will help to reduce the risk of overfamiliarity because the other one takes over as the other one retires. There is no disruption, but the fact that they are rotating, it can also help so that they don't become so much familiar. I don't think that one is a very strong point though, but if you explain it very well, then it can give you a point. But look at the main things that the ones that I gave you as advantages. Look at those areas of sharing experience, sharing risks, sharing resources, and of course, making the work become efficient because they are looking into each other. The opinion is actually quite of high confidence or high level of confidence or assurance. Those are some of the advantages. Then you look at the disadvantages. It also encourages, another advantage is that it also encourages competition in terms of the quality. It encourages competition in terms of the quality. It is also acting as a benchmark for other firms, because I'll look at what PwC is doing and I want to do the same in our firm. So the other firm becomes our benchmark. Tunaangalia hao wanatumia hii system na kuanga mzuri sana. Niliona it is even efficient. Now it is a benchmark. That standard also help us now to grow. We develop ourselves to catch up with the current technologies. So that one is a very valid point. You can talk about that. That a joint audit can actually act as a benchmark, because the firms will be able to copy from each other and even improve in the quality of their services. So now disadvantage that we talked about, the first one, an auditor may suffer from negligence of another joint audit firm. An auditor can suffer from negligence of another joint audit firm. PwC can suffer because of negligence of PKF. Because it was joint audit, they have to share. So that is why I was saying that there will be those accuses. Moja anasema ilifaa ufanye, sijui wewe ndio inafaa ufanye. So you can even be suffering because of somebody else, right? An audit firm can suffer because of the negligence of the other audit firm. We also talked about the resources from the company. Resources. Joint audit increases time spent by the senior staff on the audit team and the senior management of the group of the organization. It also it's a waste of time, because people need to learn each other's culture before you catch up. You need to understand that this is how the report should be done. So such kind of arguments can come in. Watu wanasema inafaa ikuwe hivi, wengine sisi tumezoea hivi. It will actually lead to a lot of interruptions, meetings. That one can actually waste time if people are not careful. So when they are reviewing. It is also difficult sometimes to review policies. It is very difficult to reconcile review policies of the firms. There is a way we do our review. There is a day they do their review. For us to reconcile and actually come together that, okay, let's use this one as the common review policy, is quite difficult. So you're saying it is difficult to reconcile review policies of two different audit firms. Okay, so that one plus the other ones, we can now have more points. They only wanted 3. I've given you more. I've given you more, including the ones that we looked at earlier. Is there any other question? Under advanced level, I think there was a question, I don't know the year, but there was a question about joint group audit, where somebody was auditing a group of company with different branches. I don't know the year. For advanced level, I want to give you an assignment. Advanced level. There is an assignment that I want you to try. Then we discuss in the group. Please, usinyamaze. It is for your own benefit. I want us to discuss this. It is about subsequent events yesterday, November 2015, question 3. November 2015, question 3. It's November 2015, question 3. It is about elite trading, the subsequent event question. A subsequent event question. Let us discuss it in group. It might come in exam, and we don't want you to be surprised. Any other question on group audit or joint audit? Here, you can tell me the paper and the year so that we revise. It doesn't matter the question, whether it is advanced or intermediate. It will help us to expand our knowledge. Hamjaona question kama hiyo ya group. I'm trying to look for some years where I can get it. As we look for that, let me proceed to this area. I want us to look at due diligence. Very important, due diligence. But you continue checking if you have any past paper question on group. So due diligence. Due diligence is an assurance engagement. It is an assurance engagement, 2016 question 3B. Thank you very much. Advanced level, I believe. (2016 question 3B), wacha tutafute mbio mbio ndio tuendelee. Said May 2016, sorry. Question 3B. May 2016 question 3B. Are you sure it is the ama nimeangalia gani? Is it 3B? May 2016 question 3. Question 3. Is it this one? Yeah, Sabu. Neo. It says Makali Limited acquired 75% of the ordinary shares of Makali Limited on 31st June of 2015 for 20 million. The reserves of the Makali Limited at the time of acquisition were 10 million. That one, okay, so So the reserves were 10 million at the time of acquisition. The statement of financial position of the two companies as at 31st December 2015 were as follows. So we have there the sundry assets, investment, Makali. Then we have 75 ordinary shares at par value of 100,000 each. So we have Bakari and Makali. Which one is the parent? Bakari acquired. So Bakari is the parent company. We have financed by, we have share capital, and then we have revenue reserve. So these are investment. 75 ordinary shares of this each is investment. So far is 20 million. So investment on Makali is 20 million. On sundry assets, total assets 20, and then here 50. Then we have share capital and revenue. Now, the subsidiary company was audited by another audit firm, and the directors of the holding company agreed through a resolution that the audit firm will continue to audit the subsidiary company for the year ended 2015. So it was acquired when? They are going to audit for the year ended 2015 December. It was acquired on June. So, okay. So they agreed that the audit firm will continue. So they have two different audit firms, right? This one exactly example that I've given. Describe the matters you consider in the audit of the holding company, Bakari. Tuko pamoja? See exactly. If you are auditing holding company, remember holding company. So the report, if you are the auditor of the parent company, the report must include the audit report from the subsidiary company. So what are the factors that you are going to consider? Your main focus is actually now on subsidiary, because subsidiary is being audited by a different person that is not you. So you should be worried because you are the group auditor. You have to sign on the report of the whole group, including the mistakes that were done by the auditor under the subsidiary. Those are exactly what I said here. You need to understand, mostly focus on the subsidiary. Of course, one that is quite universal is that you need to understand the nature of the group, the structure of the group. That one you can know. The structure of the group is very important for you to know, because if we say that it is a subsidiary, then you need to know how much is the contribution, or what is the influence, what is the percentage. So you need to come and know about, and you need to understand that. In this case, they have told us that it acquires how much? 75%. So meaning that a small mistake that has been done under Makali will actually impact the whole group, because Makali has contributed to the group a lot of money, right? Remember the asset for Bakari, look at, for Makali is 50 million. So that means that even Makali is a very big company, almost compared to Bakari. Makali is even bigger compared to, look at the asset base. So meaning that 75% of this is being added on this other side, like for revenue assets zote unaweka huku. So this one is subsidiary. So if it is subsidiary, when you are accounting or consolidating, you'll be taking this plus this plus this. So at the end of the day, total asset will be 40 na hii, because all the assets you need to add. So you add this plus this. Look at this. The number of assets that we have for the group, majority imetoka kwa subsidiary. This means that subsidiary has impact. So with this, you need first to understand the structure of the group and the contribution of the subsidiary to the group. That is number one, because of revenue. But for assets, it is 100%. That is number one. Number two, you come back and zeroize on, you can even first understand the nature of the group, the nature of the group business, the nature of business that the part Bakari is doing, and the one for Makali. You need to understand the nature of the group, of each member of the group, what they are doing, and the risk level for each member. So those are quite, those are 2 points. But now you come and zero down to Makali. You need to know the experience of the partners under Makali, the audit procedures that were followed, the assumptions that were used, or we can say sampling criteria. You check the audit opinion and check if it is actually supported by the evidence that is available. You look at the quantity and quality of the audit evidence from Makali, because you are going to sign, when you HAPA, you are the auditor of the holding. You are the audit of the holding, not just Bakari as a company, but Bakari as a holding. So you are the group auditor. So lazima uangalie hizo zote. Ndio maana umepewa max kama 15, because they know you'll come and get so many points like 7 or 8, and you explain each will be 2 marks. Sawa. Now they are telling you, summarize the information that you'll require from the auditors of the subsidiary company. Which information will you require from them? In audit, by the way, in some cases, you'll find that the answers that you have given here are the same. Like now you are considering some of the things that matters that you are considering is the scope of the audit. You might ask, you must consider the procedures that were followed, audit procedures. Then when you come here, information that you might require from this guy might also be the same. You might require about information that relates to the extent of the audit procedures that they performed. You want to know the sample procedures that they have used. You might want to know the risk assessment criteria that they used. Those are information that you are considering here. Na tena utawaambia huyu akupe. So in audit, answers are the same sometimes. In last year's audit, there was an audit paper in August paper. I was teaching advanced level. Then they came and told me that they know I'm not even sure if I'm going to pass. Their answers were almost the same. I just wrote everything throughout. Now imagine walipita. So question can be in a way that is actually almost the same. Don't be surprised at sasa nimepeana hiyo point hapa. Why am I going to give the same here? No. The factors that you're going to consider, in fact, some of them you might have to inquire from these guys. So they are quite the same. Just check what you are going to require from this guy. You might ask them for the sampling procedure, the audit evidence that they have gathered, yeah, to support the opinion. You might ask for the file. You can even request them to give you a file, or they show you. You can ask them information that relates to the review, because these guys are the ones who are reviewing. They are reviewing the subsidiary company. So ask them, how did you perform? What is your review policy? Show me how you reviewed. Those are the kind of questions that you'll be asking him. And that is the information that you want. The policies, review policies, because you're not going to audit again, but unataka kujua. And this thing was worrying you, and that is why you had to consider it. So it was worrying you, but now you have the opportunity to ask so that you can get clarification. It is that simple. Imagine that is 20 marks advanced level. One thing that I can assure you, ukiona tu mahesabu hivi, they will not tell you to calculate at profit and loss, consolidate. Hii hesabu ukiona, achana nayo. It is not even the main thing. Ona sasa tumesoma hiyo inakaa scary hivi. I was even doubting kama ni hiyo question, but look at the question here. You don't even need to read the question. Once you know it is a group, what matters will you consider when auditing a group? Bila kuangalia hata hii huko juu. Next one, subsidiary information that you might require. Summarize the information that you might require from the subsidiary auditor. Sasa vitu kama hizo, you don't even need a group structure or anything. Sasa advanced level watakuletea hii, but intermediate they can bring the same thing without bringing this. They only come direct to here. They only come direct to here. So it means the same thing. Let me go to due diligence, if you allow me. Can I spend a few minutes? Can I spend a few minutes to discuss with you due diligence? You allow me to pitie tu haraka kabla uende. But hiyo ya group, hiyo inakwanga tu 3 marks. Yeah, group and joint. Like now this one was joint and group. Sindio? It's a group audit but joint. Then it can be group only, it can be joint only. Both of them ni vitu utajua tu. Ni rahisi sana. Aya. You allow me to continue? Can I continue? Due diligence? Kama kuna question pale uniambie. Is there any question? I need you to comment. We have 14 people and all of them are silent. I continue, sawa. Continue, sawa. Okay, so we are talking about due diligence. We say that due diligence is an assurance engagement. You need to give conclusion or assuring somebody. Now, it is different from forensic. Forensic is not assurance. It's not assurance. Sawa. Now, due diligence, sometimes even you, when you're going to buy a phone today, Nicholas, you'll go to the shop or Safaricom. One thing that you'll ask is that you want a certain phone. Now, I need Oppo, the new one. Or you say that I need Samsung or Tecnos G, inaitwa Wise, what, I don't know the names. But of course, there's something that drove you there. Maybe people are talking about it in a positive way, so you want to buy it. But immediately you are given the phone, like now this one here. One thing that I'll first start with, if time allows, brush off pilot paper for December. Okay, we shall next week, but tutakuwa hapa. If you guys agree, can we meet still next week to continue hivi and not be repeating what we have done, but looking at other areas and revising papers? Can we continue next week? Yeah? Na mnajipanga mapema. Mnajipanga mapema. Wengine wataki kulipa mapema. 500 on Monday and you are free. Nikikuweka kwa group uko hapo permanently, we look at other things. So fine, we'll continue on Monday. Now I was talking about when you're going to buy any phone, there is something that is called due diligence. You'll always ask the seller, what is the capacity of this phone? What is the speed? What is the space capacity and what is the speed? Can it do this? What you're doing is due diligence. For those who are working in a bank, there's something that is called KYC. Know your customer. Before you open an account, you'll do KYC. Why? There are countries that the individuals are not allowed to open accounts in Kenya. Or generally, there are countries where if you're coming from such countries like Iraq, Iran, Afghanistan, ukikuja kufungua account hapa Kenya utakuwa na shida kubwa sana. So we don't want to open such countries such account. The reason is the central bank feels like, remember we did money laundering, that you can open that account, you put money there, and that money can actually help to facilitate those bad behavior in your country. And the central bank will be in trouble. World Bank will ask, and IMF. So they are saying every account that is being opened, the person or the officer in the bank must do what is called due diligence. Due diligence means know your customer. You need to understand your customer. So it is just an investigation that you are doing so that you can know more about the customer before you bring it on board. Unataka kumuelewa. Some of the questions that you can do, unamuuliza unafanya kazi gani? Where are you located? What is your possible turnover? Where are your customers? Where do you sell the goods? Such kind of questions. How long have you been running the business? Do you have account anywhere else? You are trying to know this person so that as you do business with him, you know him better. The same with the phone. I'll be asking those so many questions because I want to understand this phone. So as I buy it, I know what it can do and what it cannot. And so most sales people are very promising, but the things they are giving you might not be actual. The same thing happens with when you're buying a company. If you are going to buy a company today, or take over or merge a company, either merger or just take over or acquisition, one thing that you can always do, try to know the person that you want to buy, the company that you want to buy. Some of the things that you'll ask yourself as you try to buy that company. In line with the KYC, here you want to know the seller or the product, know your product. So one of the things that you'll ask, who are the owners of this company? Is there any liability that is pending that we need to pay? You can buy a company today and realize iko na deni ya KRA kibao. Unaenda kulipa miaka yako yote. So you need to know, do they have any amount that is pending in KRA that needs to be paid, any liability? Do they have any case in court? Who are the directors? What are their integrity or CVs? What are the nature of the business? Who are their competitors? Who are the core management? Wakina nani wanakaa kama msingi? The people who are like the rocks in that particular company. Without them, the company cannot run. What is their policy? What are their plans for the next year? What is their forecast? Right? Who are the governance, the board of governance? Where do they sell their products? And raw materials wanatoanga wapi? Raw materials wanatoanga wapi? Now that one is called due diligence. So in definition, you can say that due diligence is an investigation. It is an investigation done by a practitioner on behalf of a buyer in order for the buyer to make a buying decision. It's just an investigation that you do, you as the practitioner, you do it on behalf of the buyer so that your client, who is the buyer, your client is the buyer, so that the buyer can make the right decision to buy or not. Now you can be given an assignment where they want you to do such kind of investigation and give conclusion whether it is true and fair. Now for financial statements, or for companies that is operating, some of the things that you will check when you're doing due diligence, and it's quite different from financial audit. It is different from financial audit. It is actually broad. It is broad, and also in terms of the years, the scope is quite large. With due diligence, you'll not be told to do for only 2020. No, you are allowed to go to several years ago. You try to investigate, and even now look at the forecast. What are they planning? That is due diligence. Unaenda nyuma kabisa na unaenda mbele na pia unaangalia hapa sahihi. For financial audit, they are called statutory audit. You don't need to do that. You don't need to go beyond the period that you're given, unless there are things that have impact on that and you want to understand, but you are not expected to go to 2020. It is audit for 2021, you only concentrate on 2021. So what are the areas that you want to do to check as you perform due diligence? We talked about financial audit. You look at the financial report for several years ago, and even the current one. Then you look at the prospective financial statements or prospective financial information. That is PFI. PFI are basically information for the future. Prospects, we expect, it is possible. So the possible financial information that they expect. The one in the future, like now the cash flow, the expenses for next year, the plan, the forecast. And then you also check at the minutes from the management. What are the management of the board of directors saying about the current state of the company? Unaangalia minutes of the board of directors. Unaangalia wanasemanga nini. You can also look at the management accounts. Those are also areas that you check. The management accounts. What is the management report indicating? You want to see. Then you now start looking at the raw products. Wanatoanga wapi raw products? What is the source? Who are the suppliers? And how stable are they? Like now, if you want to buy a company that is dealing with gases and the supplier probably is Russia, and you know that there is sanction, you cannot advise your client to go and invest in that company. A company that is dealing with raw products that come from Russia, and today there are sanctions everywhere, and we are not even sure this war will end up where. It can be World War III. Just imagine if you invest in a company like that, your money will go into the sea, utapoteza. So as a good person, you need to know what is the risk from the raw material sources, where they get the raw material. Is there any risk? And then in some questions, like the one that I've seen, they were given a situation where the client is trying to buy a company that is involved in mining. And this company that is involved in mining is claiming that they detected a new deposit. So if that is the thing, remember when they are selling, they will actually put a higher price claiming that they have a new deposit that has not even been utilized. It is still there, intact. So they will quote more because you are going to benefit. As an auditor, you now need to go and check what is the capacity and quality of this new deposit. Does it even exist? Na kama iko inatoshana aje? And what is the value of the deposit inside there? Ndio wakikuta huku, unajua your client will get something back. So that is basically about due diligence. That's about due diligence. Now, some of the questions that they can ask you are the challenges that you can face when you are performing due diligence. In due diligence, they can give you a case study, or they can just ask you what are the challenges. We know some of the challenges that, as an auditor, you might not be an expert in everything. So you might need an expert to come and help you. That is a challenge, but you don't even know how to. You need an expert to come and estimate for you the quantity of the oil deposit. In cases where you are doing due diligence in a foreign country, in cases, in exam, they don't give you case study, but wamekuuliza two challenges. Then you can give example that in cases where you are going to do due diligence in industries where you don't understand, then you might need an expert, which again, the challenge is to know the quality of the work of the expert, because the expert understands what you don't understand, and you're going to depend on his work. So again, you have to do more work on the expert so that you can believe in it or depend on his report. In case you're going to do diligence in a foreign country, you have another challenge. The challenge is legal requirement. Your client is going to buy a company in Uganda. Do you know the tax legal requirement, the tax issues there? Do you know the requirement to open a company or even to operate there? Do you know the requirement in terms of the environmental factors there? Do you know the requirement in terms of the social responsibility? Maybe they will tell you that the CEO must come from there, even if the CEO is not qualified, but you have to employ their own engineers. That one might be some of the political and legal requirements. Then also, we have also political issues. Like, how can you invest in Kenya and you know that every election, there might be some skirmishes? You might be skeptical. So towards the election, you tell him, hold, wacha tungoje tuone vile inakaa. Hii ni example too. I'm not saying that it is happening. It's just an example. That towards the election, again, you can tell him, be skeptical, ngoja kidogo tuone vile inakuwa. Then maybe after that, you can go and invest. Those are some of the challenges that you might have to understand the political terrains. Other things are language barriers that can also be a challenge. When you're doing diligence, you're going to interview people, you ask them about the suppliers, you ask the suppliers how they get their resources. You might reach a situation where the suppliers don't understand your language. You know, even Germans don't speak English, and they're even struggling to speak English compared to us. They are struggling. We speak better. So imagine you are going to Germany to do due diligence. You know English, but that cannot help you there. So language barrier. We also have discriminations, like racial discrimination. When you go somewhere, they're saying, we're in black, I'm aware when it's tribe plan, you know, so they don't even want to associate with you. Ati huyo ditani, unasema ni mkabila gani, ama from which continent? Some people say that they don't even know where Africa is. So such kind of things, we have some kind of discrimination that can also be a challenge. Now, in exam, they can give you a case study or they ask you direct. If they ask you direct, give example. Say that in cases where you have to do it outside the country, then these are the challenges. In cases, so give example. But if they give you a case study, then now give relating with the case study. Another question that they can ask you is about the scope of due diligence. To what extent can you be able to cover when you're doing due diligence? Or they can ask you about the difference between due diligence and the normal statutory audit. So the scope we have said, you audit the previous year's report, the current one, you also look at the future. You look at the management reports, management accounts, you look at the board minutes, you look at the forecast and the plans, you check the sources of raw materials, you look at a lot of things that you can look at. You look at the governance, who are the governance, the experience, their CVs, right? Then you can even look at maybe the potential competitors. What are the competitors doing? Which strategy are they doing right now? The company that you are going to buy, which strategy are they applying now to beat the competitor or maintain relevance in the market? And what are they planning to do so that they can capture the market? Then you can also think about maybe their market share. What is the current market share in the market? As you're going to buy it, you're buying Safaricom or Airtel. If it is Airtel, be ready that you're going to fight thoroughly for you to be able to get a good number in the market, because that is the fact. If it is Safaricom already that know that you are at the top, ask yourself, which strategy are they using and who are the key management leadership? Who are the key managers that I should not even touch? So as you take over, you need to know the employees that matter. Kuna wengine wanaweza enda, but kuna wengine ukisikia wanaenda, unakubali kuongeza salary wasiende. Wakienda, you are done. So those are areas that you need to consider. In terms of the differences between statutory audit, we've talked about the scope. Scope is different. And also now we are talking about the requirement. For statutory audit, it is legal requirement. For statutory audit, it is a legal requirement by law. But for due diligence, you are doing it, it is not legal requirement. Again, the users of information. Due diligence is only for your client. Yeye ndiye anadecide kununua or not. But for statutory audit, the users are actually the public, the competitors, the client, the government. The users are quite many. So again, that is also another difference. In terms of the timing, due diligence you can do anytime when the client wants to buy and he has contracted you to perform that kind of activity or engagement. Due diligence, anytime. But for statutory audit, it is done at the end of the year. Every financial year ikiisha, then that is when you do it. Mnaona tofauti iko, si ndio? Tofauti iko. Again, due diligence is an in-depth examination. Ni ile unaenda deep examination. But for statutory audit, it is not that deep, like due diligence. Again, statutory audit, the scope is quite wide, but due diligence, you can be given a line. It is like special. Unaambiwa, nataka uangalie this company. I want you to look at the quality of this this area. But for the other one, you can look at the areas that you can. They are actually guided under. They are guided under ISAs. Statutory audit are actually guided under ISAs, the scope. Some of the difference that you can also write. Under due diligence, you might not be considering internal controls very much. You might not be trying to assess the weaknesses and the strength in internal controls, because those are things that you know that when you take over, when ndio utaweka, sio the policies when ndio utajiwekea. Lakini for statutory audit, you are so much concerned with the effectiveness of internal controls, because one of the responsibility of the auditor that we agree with is that they have to check and confirm whether internal control is there and it is working. Lazima uangalie kama iko na inafanya kazi. That was one of the responsibility of the auditor in statutory audit or financial audit. But under due diligence, hakuna kitu kama hiyo. Utafanya tu, the main aim is to uangalie the quality and the possibility of you managing the product and the value that is there in the business. You are not even concerned much about, the aim is not to check on the internal controls. Under statutory audit, you are looking at the financial years for the previous year only, unless there is subsequent event that overlaps into the current year, but you are only auditing for the year that you are given. But for statutory, for due diligence, you look at the previous years, the current year, and even the future. So again, it is quite different in terms of the scope. So the objective is to know or to give. The objective again is to give conclusion on whether to buy or not, to give a decision. But the objective for statutory audit is different, is to give an opinion in terms of adverse, qualified, disclaimer, or unqualified. And of course, you are also expected to give a report on the fair view of the financial position. In this one, you are only advising or trying to advise on whether to buy or not. You're not going to say whether it is representing true and fair view. No. The reason why sometimes you go back to the historical financial information, you might find that right now the financial information for the current year is looking nice because they knew they wanted to sell the product or the company. So they can fake figures, what we call fraudulent reporting. Fraudulent reporting. You can do that. But again, when you look at the previous years when they didn't have that mind of selling, the company was making losses. Sahi sasa inaonyesha ina make profit because they want it to look beautiful. So that's why you need to check the previous, look at now, and then look at the forecast. You look at the predictions and the forecast for the future. I'll stop from there unless there is a question under any of the areas that we've covered. Otherwise, allow me to close there, and we call it the end of class for this week. I hope you are getting value for your money. We'll continue knocking the doors of different questions to see if we can be able to have enough confidence so that we can meet the exam with the force that it deserves and apply our skills, God willing. We don't want to go to exam when we are scared. You don't need to fear this paper. We have to pass it. Any question? For advanced level, that question was asked. You can check. It was asked in 2018 May. That one for due diligence. Utaangalia May 2018, advanced level. May 2018, they were asking the difference between financial audit and due diligence. We also have a case study for May 2018. Oh, this one, May 2018. This one is about joint audit, or group audit. It's group audit, May 2018 question. Question 5. That one is group audit or group audit. Then this other one, the first one is question number Question number 2. Question number 2, due diligence. Both of them May 2015, 20 marks each. So advanced level, utaangalia hiyo, we have discussed them. Ukiangalia utapata ni zile vitu tumediscuss. May 2018 question 5 for group audit, and then we have May 2018 question 2. Question 2, yeah, question 2B. Sawa. Question 2B. Hizo nimeona hapo. I think for intermediate I gave you the question that was set. Sindio, tumeangalia joint 2011. And if you have any question, you can always ask in group. We can discuss. Msinyamaze, I want the group to be very active. Alafu, now as I leave you, invite some of your colleagues, even if they are in other colleges and they are willing to attend this class. Waambie wakuje. Some of them called me yesterday saying that they didn't know that we are doing this. Waambie wakuje, 100 per day, unalipa one of 500, then we run the whole week. See you, have a good evening. Or good afternoon, yeah? Good afternoon. Our today's class equal, by the way. Let's meet in class. We have class as usual today, Sambili usiku. Those who have not paid, you can pay and join 500. Today's class.